Usually when we talk about a medical diagnosis, there's this expectation of precision.
Right, yeah. Like it's definitive.
Exactly. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points to it. Broken or not broken, it's clean.
Yeah, it's comforting.
It is. It's comforting because, we like things to be visible and categorized. But if you step into the financial markets today, that x-ray machine is showing a perfectly healthy marathon runner who is simultaneously like in the middle of a massive heart attack.
I mean, it makes absolutely zero sense on the surface.
None at all. So welcome to the deep dive. It is Thursday, August 13th, 2026. And today we are unpacking a historic real-time paradox that's playing out right in front of us.
A really profound one, yeah.
Yeah, because on one side you have the S&P 500, which just shattered a historic ceiling, breaking through the 7,800 mark for the very first time.
Which is wild.
It is wild. And on the exact same day, we've got legendary contrarian investors doubling down on these apocalyptic systemic doomsday bets.
It really is the definition of diagnostic muddy waters.
Yeah.
You look at the tape, the pure price action, and it tells a story of absolute euphoria.
Right.
But then you look at the positioning, the underlying plumbing of the market, and the actual capital deployment of some of the smartest money in the room, and it tells a terrifyingly different story.
Exactly. And to figure this out, we are pulling from a massive stack of sources for you today.
We really had to dig deep for this one.
Yeah, we've got financial reporting from 247 Wall Street, deep macroeconomic data drops, geopolitical live blogs tracking military movements, and, of course, Substack newsletters from some of the most infamous market bears out there.
Putting all the conflicting pieces on the table.
Right, just to see how they actually fit together.
And we really need to start with the raw numbers, just to grasp the sheer scale of the momentum we were dealing with here.
Yeah, set the scene for us.
So let's look at the market. Thursday, August 13th, the S&P 500 reached an intraday all-time high of 7,816.70. Yeah, and it eventually closed just a hair under that milestone at 7,799.188. And to give you, the historical context of the velocity here, the broad market has surged roughly 25% from its late first quarter correction lows just a few months ago.
A 25% rally in an index that tracks the 500 largest companies in America. I mean, that is a face-ripping rally.
That's massive.
It's adding trillions of dollars in market capitalization in a matter of weeks.
It is staggering. And if you zoom out even further, looking at the historical resilience of the U.S. economy, the S&P 500 has hit all-time highs in 42 out of the last 68 years.
Wait, 42 out of 68?
Yeah. So breaking records is practically embedded in the DNA of the index. The baseline expectation is growth. So right now the market is popping champagne.
But then in the exact same week that the market is celebrating 7,800, we get a completely different signal. We get Michael Burry.
The Big Short legend himself.
Right. The guy who famously dug into the tranches of subprime mortgages and called the 2008 housing crash. He writes this note to the subscribers of his Cassandra Unchained Substack, and he essentially says that this historic calm, this beautiful, flawless upward trajectory is actually a massive, blinking red warning sign of a systemic failure.
And the thing is, he isn't just writing about it. He is putting his capital directly into the line of fire.
Yeah, he's actively trading this.
Exactly. He is outright refusing to cover his short book. Yeah. He's holding on to these massive, highly leveraged bets that the market will fall, even as those positions currently sit deeply underwater.
Because the market keeps going up?
Right. And he explicitly warned his readers of and this is a direct quote, a possible 1987 type fall.
A 1987 type fall. Black Monday, the day the Dow dropped over 22% in a single trading session.
Yeah, it's not a light comparison to make.
Not at all. Okay, let's unpack this. Because to understand this massive clash between flawless, record-breaking market performance and Burry's doomsday skepticism, we first need to look at the macroeconomic fuel that is driving this rocket ship.
You don't get to 7,800 without some incredibly strong tailwinds.
Exactly. Let's look under the hood of this week's data drop, because Wall Street threw an absolute party over the CPI and PPI numbers, but how much of that was actually justified?
Well, the data threaded the needle almost perfectly for the bulls. So the July headline Consumer Price Index, or CPI, slowed to 3.4% year over year.
Which is, what, pretty low on a monthly basis?
Yeah, it was just a 0.1% increase on a monthly basis. But the Federal Reserve, as we know, watches the core CPI much closer.
Because that strips out the highly volatile stuff, right? Food and energy.
Exactly. You strip out gas and groceries, which bounce around a lot, Core CPI ticked down to 2.5% year-over-year and just 0.2% monthly.
So it's finally hovering right in the neighborhood of the Fed's magic 2% target.
It really is. And on the wholesale side, the Producer Price Index, the PPI, was even better.
Oh, the PPI numbers were crazy.
They were. July's headline PPI came in completely flat, like 0.0% month over month, when the street was expecting a 2.2% rise. And the core PPI measure fell to 4.2% year over year.
So you have easing price pressures at both the factory gate and the cash register.
Exactly. And when you pair that with the labor market data, we saw jobless claims tick up slightly by 9,000 to reach 209,000.
Right, so we have this cooling inflation and a labor market that isn't running quite as red hot as it was last year.
Which is exactly what the Federal Reserve has been engineering. I mean, they want to cool demand without triggering mass layoffs.
So because of this specific data combination, the futures market basically instantly repriced the cost of capital, right?
Yeah, a September rate hike is virtually off the table now.
Yeah.
The implied probability dropped to just 35%.
And a cut is basically a sure thing.
Pretty much. The market has priced in a 94% probability of a rate cut by the end of the year.
So the market is just banking on cheaper money. Is this basically like an overheating car engine where the temperature gauge is finally dropping back into the green zone, meaning the Fed can finally take their foot off the brake?
That is a brilliant way to visualize it. The Fed has had both feet standing on the brake pedal with these elevated interest rates.
Trying to slow the car down?
Right. And now the temperature gauge is dropping, and the market is pricing in the exact moment the Fed lets off the brake and, maybe even taps the accelerator with a rate cut.
But let me push back a little on that car engine analogy, particularly regarding the labor market. We have 209,000 jobless claims. I know the consensus is celebrating this as the elusive soft landing, but doesn't a labor market usually deteriorate in a nonlinear way?
Yes, almost always.
Right, so are we truly in a soft landing, or are we just one bad month away from the engine stalling out entirely into a recessionary spiral?
What's fascinating here is that you've just highlighted the exact tightrope the Fed is walking. 209,000 claims is historically very healthy. It implies a tight labor market.
People are still employed.
Exactly.
Oh.
But to your point about nonlinear deterioration, employment doesn't usually degrade on a smooth, predictable slope. It happens in step functions.
What do you mean by step functions?
Well, companies freeze hiring first, then they cut discretionary budgets, then suddenly a major player announces a 10% workforce reduction, and their competitors follow suit out of a herd mentality.
Oh, but like a domino effect.
Exactly. So yes, right now the data screams soft landing, but the bears argued that the transmission mechanism of these high rates is still working its way through the system, and that step function drop could hit at any moment.
And there's another fascinating quirk in this inflation data that our sources pointed out, specifically hidden inside the PPI report. It has to do with portfolio management services. Walk us through that, because it sounds like a snake eating its own tail.
Oh, it absolutely is a feedback loop. So in the PPI report, the cost of portfolio management services jumped 6.5% for the month.
Which sounds like massive inflation.
It does. But why did the cost of managing money go up? Because portfolio management fees are almost universally charged as a percentage of assets under management, or AUM.
Right, the classic 1 or 2% fee you pay a financial advisor.
Exactly. So as the S&P 500 rallies 25% and hits all-time highs, the raw dollar value of the assets goes up. Therefore, the dollar amount the managers charge goes up.
Wow.
Yeah, and that increase in fees gets captured in the PPI data as a price increase. So the stock market's own euphoric success is mechanically creating a phantom inflation bump in the wholesale data.
That is wild. I mean, the Bureau of Economic Analysis will eventually adjust for that, I imagine. But in the raw print, Wall Street's success makes it look like services inflation is stickier than it actually is.
It's a total data mirage, but the algorithms trade on it anyway.
Right. Still, taking it all together, the domestic macro picture looks pristine to anyone buying the dip. But when we pivot and look abroad, the contrast is jarring. We've got major geopolitical friction.
Huge friction.
Yet, paradoxically, global chaos isn't derailing this bull run at all. Let's look at the Middle East, specifically the drama surrounding the Strait of Hormuz.
Yeah, if you look at a map of global trade, the Strait of Hormuz is arguably the most critical geopolitical choke point on the planet.
Because of the oil.
Exactly. Roughly 20% of the world's global oil supply flows through that narrow stretch of water. It is the jugular vein of the global energy market.
And our sources detail extreme escalation there this week. We are talking about 6 consecutive nights of U.S. strikes on Iran.
Serious kinetic action.
Yeah, we have reports of washed-up oil spills on Qeshm Island from a foreign bulk carrier. Historically, if you have missiles flying over the jugular vein of the oil market, crude prices explode.
Right.
You see a massive risk premium priced in immediately.
Almost instantly, yeah.
But that didn't happen.
It didn't. In fact, it did the exact opposite. Despite the strikes and the oil spill, crude prices fell.
Which is counterintuitive.
Completely.
Yeah.
West Texas Intermediate, or WTI, dropped to $81.74 a barrel, and Brent crude fell to $87.38 a barrel.
How do we explain that? Why is the market actively shrugging off missiles near the most important oil choke point on Earth?
It comes down to what the market is pricing in for the future, rather than what is happening on the ground today. The energy market is heavily pricing in optimism over a framework deal between Iran and Oman.
Okay, a diplomatic back channel.
Right. The belief is that this back channel will successfully reopen the shipping lanes and ensure safe passage. Traders are looking past the immediate violence and betting massive amounts of capital that game theory holds up.
Meaning what exactly?
Meaning the economic cost of a closed strait is so mutually assuredly destructive to all parties involved that a diplomatic resolution is basically inevitable.
And we are seeing this high-stakes game theory play out in a massive war of words on social media, too. Now, viewing this purely as market variables, and we need to be very clear here for you, the listener, we are impartially reporting the contents of our sources and not endorsing any political viewpoints or taking any sides whatsoever, because the market itself doesn't have a political affiliation. It only cares about supply and risk.
Right, the market is entirely neutral. It just wants to know if the oil is flowing.
Exactly. So with that said, you have President Trump taking to Truth Social, claiming total control over the waterway. He posted, quote, "I think we will keep it."
Very direct.
Very. And on the other side, you have Tehran signaling the exact opposite. Iranian Foreign Minister Abbas Araghchi stated that the U.S. is making a, quote, "bigger miscalculation."
It's extreme posturing from both sides. But while the broad market is assuming a diplomatic resolution and selling off crude, there are hidden corners of the market quietly making an absolute fortune off the structural volatility this creates.
The refiners.
Yes.
Companies like Valero and Marathon. Our sources noted that energy was the best performing sector this week, completely led by these downstream refiners. And we break down the mechanics of this because if crude oil prices are falling, why are refiners having a blowout quarter? You always hear analysts talk about crack spreads, but what does that actually mean?
The crack spread is the absolute lifeblood metric for a refiner. So to visualize it, think of a refiner as an industrial bakery.
Okay, a bakery.
Right. Crude oil is the raw flour they buy, and refined gasoline or jet fuel is the baked bread they sell to consumers. The crack spread is simply the profit margin, the difference in price between the raw input and the finished output.
Okay, so how does a geopolitical crisis in the Strait of Hormuz manipulate the price of flour versus bread?
Well, when geopolitical fears flare up, the price of the raw crude the flour can experience violent intraday spikes before settling down. Or, supply chains get briefly rerouted, which raises logistical costs.
So their input costs get messy.
Exactly. But here's the structural advantage refiners have. Consumer demand for gasoline and diesel is incredibly inelastic in the short term.
Meaning people still have to buy it no matter what.
Right. People still have to commute to work. Commercial airlines still have to fly their routes. Trucking companies still have to deliver groceries. So when the refiners' input costs blip, they immediately raise the wholesale price of the finished gasoline, the bread, to compensate and protect their margins.
But when the price of crude oil drops back down, like we just saw with WTI falling to $81, they don't immediately lower the price of the gasoline at the pump, do they?
Exactly. Prices go up like a rocket and come down like a feather.
Ah, rockets and feathers. I've heard that.
Yeah. So the gap between the input cost and the output price widens significantly during these periods of volatility. Refiners capture that expanded margin. It's a high-torque play. They thrive when the market is nervous, but demand remains sticky.
That makes perfect sense. But let me zoom out on this whole Middle East dynamic for a second. If 20% of the world's oil flows through this strait, aren't macro funds playing with absolute fire by assuming a diplomatic deal is a sure thing?
They absolutely are.
It feels like investors are watching a bomb squad at work and betting heavily that they cut the right wire simply because they've cut the right wire every time in the past.
That is the exact danger of an evaporating risk premium. The market has been conditioned over the last 30 years to believe that extreme geopolitical escalations will always be contained.
Because they usually are.
Right. But to your bomb squad analogy, If they ever do cut the wrong wire, if a kinetic strike accidentally hits a major carrier, or if the strait actually closes, the repricing of global oil would be violent, instantaneous, and would ripple through every single sector of the S&P 500.
So if the geopolitical risk premium is basically evaporating because traders assume diplomacy will win, where is all that confident capital actually going?
It's not sitting in cash, that's for sure.
No, it is pouring directly into the most aggressive corporate earnings beats we've seen in a decade, specifically in the artificial intelligence sector.
The earnings we saw this week were nothing short of staggering. I mean, they weren't just beats. They were structural paradigm shifts in how these companies are monetizing.
Let's start with Palantir, ticker PLTR. They smashed every estimate on Wall Street. We're talking Q2 total revenue of $1.94 billion, which is up 93% year over year.
Which is huge for a company of that size.
Right. But the real story, the number that had analysts dropping their jaws, was their U.S. commercial revenue. It surged an astonishing 149% year over year to $764 million.
That is just unheard of growth.
And their net income, $1.1 billion. That net income exceeds their entire total revenue from the exact same quarter last year.
It is an absolute masterclass in software operating leverage. But the metric that truly defines how anomalous Palantir's quarter was is their Rule of 40 score.
Let's define that for the listener, because the Rule of 40 is a very specific institutional benchmark for software as a service companies.
Right, yeah. The Rule of 40 is a standard metric used by venture capitalists and software investors to balance growth and profitability. You simply add the company's revenue growth rate percentage to its profit margin percentage.
Okay, so growth plus margin.
Exactly. And the rule dictates that if that combined number is 40 or above, it is considered an elite, top-tier, healthy software company.
So if you grow 20% and have a 20% margin, you hit 40.
Yes. It basically means you are either growing fast enough to justify burning cash, or you are profitable enough to justify slower growth.
Okay.
Palantir's score this quarter wasn't 40, it was 155%.
155%. That literally breaks the scale. It's like a student walking into a final exam and scoring 155%. How is that mathematically possible? How do they scale U.S. commercial revenue by 149% without their costs exploding at the same time?
Well, it comes down to their go-to-market strategy with their artificial intelligence platform, or AIP.
How did that work?
Instead of traditional lengthy enterprise sales cycles where executives deliberate for months, PowerPoint presentations, endless meetings, Palantir has been running these AIP boot camps.
Boot camps, like bringing the clients in.
Exactly. They bring potential commercial clients' engineers in, integrate Palantir software with the client's actual proprietary data, and build a working AI application in a matter of days.
So they prove it works immediately.
Right. The conversion rate from these boot camps is massive. And because the core software infrastructure is already built, the marginal cost of adding a new enterprise client is practically zero.
Ah, so there's no overhead for each new client.
Exactly. Every new dollar of revenue flows almost entirely to the bottom line, resulting in that $1.1 billion net income.
And it wasn't just Palantir proving the AI boom is real. Look at Nabius Group, ticker NBIS. This is an incredible story. They are an Amsterdam-headquartered, NVIDIA-powered AI cloud provider.
Yeah, really interesting background on them, too.
Right. What's fascinating is they were actually spun out of the Russian tech giant Yandex as part of a complex restructuring. Their stock surged 34% on August 12 alone.
34% in one day.
Yeah, why?
Right.
Because their Q2 revenue jumped 454% year over year to $582.3 million. And their specific AI cloud revenue made up almost all of that, up 514%.
It's exponential. And we can't forget the physical infrastructure players either. The hardware and memory chip makers who provide the picks and shovels for this AI gold rush.
Right, they're making a killing.
They really are. SanDisk jumped 16.6% after forecasting mid to high teens revenue growth all the way through fiscal 2028 and 2030.
Which is great, but the margin target was the crazy part.
Oh, the non-GAAP gross margin target was an eye-watering 80%.
80% margins on hardware.
I know. Western Digital followed suit, climbing 8.6% on robust results. Supermicro Computer SMCI was up 9.5%. It is just a tidal wave of capital expenditure flowing into hardware.
If we step back and look at this mechanically, this feels like a massive shift in the narrative. For the last 2 years, artificial intelligence was a story of promised infrastructure.
Yeah.
It was all about capital expenditure. Meta, Microsoft, and Google spending tens of billions on NVIDIA chips, building massive data centers, and basically telling Wall Street, trust us, the applications will come. It was the build it and they will come phase.
If we connect this to the bigger picture.
Yeah.
Exactly. But now, with Palantir showing 149% commercial growth and Nebius showing over 500% cloud growth, we have aggressively entered the show-me-the-money phase.
They are actually monetizing.
These companies are proving to the market that enterprise clients are actually willing to pay top dollar for applied AI right now.
Here's where it gets really interesting, though, right? Because I have to ask you, are we looking at a permanent paradigm shift in corporate efficiency? Like, are we witnessing the invention of the internet or electricity all over again?
That's the trillion-dollar question.
Or is this the Cisco of 1999? Is this just the ultimate hardware sugar high before these non-tech Fortune 500 companies realize they bought way too much compute power and don't actually have the proprietary data to utilize it?
This raises an important question, and it's the exact fault line dividing Wall Street right now.
Right.
The bulls argue that AI creates a permanent productivity miracle, which is deflationary in nature, and that it will expand profit margins across every sector.
Which explains some of the non-tech wins we saw.
Yeah, exactly, which is why you see companies like Birkenstock up 16.3% on strong results. The consumer is still spending while corporate margins widen.
What about the bears?
The bears argue that this is a cyclical capex bubble fueled by executive FOMO, fear of missing out. They argue that companies are panic buying cloud space and GPUs to appease their boards, but that the actual return on investment for an average logistics company or a retailer won't justify that initial hardware spend.
And that doubt is the perfect pivot for us. Because if you look closely, not everything is glittering right now. And some very, very smart people are betting their massive fortunes that the sugar high is about to crash. Hard.
Oh, absolutely.
Let's look at the bears, the guidance cuts, and the massive short book being built against the 7-800 market.
We have to give the bears their due, because if you strip away the AI darlings, there are serious cracks showing in the broader economic facade.
Yeah, far from every report being a blockbuster. Let's look at the week's high-profile losers. Cisco Systems fell after forecasting sales of $7.5 billion and showing disappointing margins. Cerebras tumbled over 11% after missing Q2 revenue expectations.
And consumer-facing ones, too.
Right, Tapestry, the luxury fashion holding company that owns brands like Coach, plunged 16% on week forward guidance, despite actually beating their headline Q4 earnings. And StubHub slid over 13% after missing quarterly earnings entirely.
Those specific losers tell a very cohesive story. When you see Tapestry and StubHub taking double-digit haircuts, it tells you that the discretionary consumer is exhausted.
Yeah, the everyday person.
People are pulling back on luxury handbags and expensive concert tickets. The savings buffers built up over the last few years are depleted.
And what about on the enterprise side with Cisco?
On the enterprise side, Cisco's struggling shows that traditional non-AI tech infrastructure spend is actually contracting. IT budgets are being cannibalized to pay for all these AI projects.
It's a zero-sum game for IT departments right now. You either buy AI or you buy routers.
Exactly.
But no one embodies the bear case, the belief that this entire structure is rotten, quite like Michael Burry. Let's look at what he did on August 12th, the exact same week the S&P hit 7,800. He aggressively added to his short positions.
He is leaning heavily into the pain.
He really is. He is shorting Nebius at $212 a share, despite their 454% growth. He's shorting Micron and Oracle. He's holding an underwater NVIDIA put option with a $110 strike price. He's shorting Tesla. He's shorting Caterpillar.
It's a massive, sweeping short book.
And perhaps most shockingly, he is heavily shorting Palantir, claiming the company is intrinsically worth less than $1.
Less than $1.
Less than $1. A stock that just posted a Rule of 40 score of 155% and printed $1 billion in net income. How does he fundamentally justify betting against that kind of momentum?
To understand Burry, you have to realize he doesn't just look at headline revenue. His structural bear case is deeply rooted in the opaque plumbing and accounting mechanics of the market.
Okay, break that down for us.
We can break his argument down into three specific pillars: depreciation accounting, off-balance sheet commitments, and volatility feedback loops.
Let's take these one by one, because this is where the diagnostic X-ray really gets murky. Walk me through pillar 1, depreciation accounting. How does that make an AI company's earnings a mirage?
It comes down to how capital expenditures are legally recorded. So, when a massive tech company buys $1 billion worth of NVIDIA H100 GPUs, they do not expense that $1 billion on their income statement all at once.
Why not?
Because that would destroy their quarterly profit. Instead, accounting rules allow them to capitalize that asset and depreciate it over its useful life.
Okay.
So they might spread that $1 billion cost over 4 or 5 years on their books. They take a smaller hit each quarter.
Okay, that makes sense for like a factory or a delivery truck, but hardware advances at light speed. A top-of-the-line AI chip today is going to be incredibly inefficient, if not entirely obsolete, in a couple of years.
Exactly. And that is Burry's entire point. He argues that these infrastructure firms are aggressively stretching the useful life of these chips on their balance sheets to 4 or 5 years just to hide the true cost of the build-out.
Oh, wow. So they are pretending the chips will last longer than they will.
Right. Realistically, given the pace of AI advancement, this hardware becomes functionally obsolete in 2 to 3 years. By deferring the cost, they are artificially inflating their current earnings today while ignoring the massive replacement costs looming tomorrow.
It's the dot-com bubble all over again. In the late 90s, telecom companies laid millions of miles of fiber optic cable, capitalized the expense, and reported massive phantom profits right up until the moment they realized they had vastly overbuilt and the asset values collapsed.
That is the exact historical parallel Burry is drawing, which leads directly into Pillar 2, off-balance sheet commitments. In his Substack, Burry used a very evocative phrase. He warned that the fish have gotten very fat.
What does that mean in an accounting context? Where are these fat fish hiding?
He is referring to uncommenced leases and massive forward purchase commitments. If you dig deep into the footnotes of the 10Q filings of these hyperscalers, the massive cloud providers, you will find tens of billions of dollars in obligations that aren't technically classified as debt on the primary balance sheet yet.
Wait, pause there. Uncommenced leases. For someone looking at a standard balance sheet on Yahoo Finance, where are these hidden?
They are buried in the footnotes.
Are these literally empty data centers or nuclear power plants that tech giants have signed 10-year contracts for but haven't officially moved into yet?
That is exactly what they are. They sign a 15-year lease for a massive gigawatt data center facility that is currently under construction.
Right.
But because the lease hasn't commenced, meaning they haven't taken possession of the building yet, the massive liability doesn't hit the balance sheet in a way that algorithmic screeners flag as debt.
Oh, so the screeners miss it entirely.
Exactly. Burry is pointing out that these companies have locked themselves into astronomical fixed future costs. If the AI revenue growth slows down even slightly, those off-balance sheet commitments will crush their operating margins.
So if the accounting is smoke and mirrors and the debt is hidden in the footnotes, why hasn't the market punished them yet? Why is the S&P still breaking 7,800?
Because of Pillar 3, feedback loops and the VIX. And this is the most structural, mechanical part of Burry's argument.
Okay, the VIX.
Right, the VIX is the volatility index, which tracks the implied volatility of the S&P 500 based on options pricing. It's often called Wall Street's fear gauge. This week, the VIX dipped under 16, closing around 14.63.
A low VIX means the market is incredibly calm. It's that flawless upward trajectory we were talking about.
Right. But Burry argues that in today's highly financialized market, a low VIX is actually a mechanical trap.
A trap. How?
There are massive multi-billion-dollar institutional funds called volatility targeting funds. They use something called value at risk, or VAR models.
Let's define VAR for the listener. How does a value at risk model force a fund to act?
A VAR model calculates the maximum potential loss a portfolio could suffer over a given time frame based on current market volatility. The mandate of these massive funds is to keep their risk constant at all times.
Okay, so they have a target risk level.
Exactly. So when the VIX drops below 15, the VAR model tells the fund manager, the market is incredibly safe right now. To maintain our target risk level, you must increase our exposure.
Wait, really? So the algorithm basically acts like a driver who is programmed to press the gas pedal harder the smoother the road looks, entirely ignoring the fact that there might be a cliff 2 miles ahead.
That is a perfect analogy.
Yeah.
Because the VIX is low, these computers are forced to blindly buy equities and add leverage, completely ignoring the fundamental valuation of the companies they're buying.
They don't care about the PE ratio, they just buy.
Right. And this blind buying pushes stock prices up, which suppresses realized volatility even further, which drops the VIX even lower, which forces the VAR models to buy even more.
It's an automated, self-fulfilling loop.
Exactly. Burry argues this mechanically pushes the market higher and stretches it like a rubber band. The lower the VIX goes, the more synthetic leverage is added to the system.
So what happens when it snaps?
When a true exogenous shock finally hits and volatility spikes, those same VAR models will forcefully reverse. They will mechanically dump stocks to reduce risk, causing a cascading liquidation. It is the exact same portfolio insurance mechanics that caused the 1987 Black Monday crash, just updated for the algorithmic age.
But let me challenge this because I think a lot of people listening have the same nagging thought. Burry is famous for The Big Short. He was dead right on subprime mortgages.
It was, yeah.
But hasn't he been predicting a massive systemic crash almost every single year since? I mean, he shorted Apple, he shorted long-dated treasuries, he deleted his Twitter account multiple times after making ominous predictions that never materialized. At what point is he just the boy who cried wolf?
That is a very fair critique.
Is there real fire behind the smoke, or is he just fundamentally misaligned with modern market dynamics?
It is the defining critique of Michael Burry. He is almost always early. And because of the mechanics of shorting, being early is often indistinguishable from being wrong.
Right, because you bleed out from the costs.
Exactly. But what you have to respect is his analytical framework. He isn't just a perma-bear saying stocks are too high based on PE ratios. He is identifying highly specific mechanical vulnerabilities in the market's plumbing.
Like the VAR models.
Yes. And to your point about the boy who cried wolf, the fable ends with the boy actually being eaten by a wolf. Just because Burry has been early before doesn't mean the structural risks he's pointing out, the stretched depreciation schedules, the hidden leases, the algorithmic leverage, aren't mathematically real.
It's terrifying when you synthesize it like that. Burry is basically saying the market is no longer a reflection of healthy underlying businesses. It's just a mindless, leveraged algorithm automatically buying stocks because things seem too quiet.
He is betting against the prevailing narrative, and he is betting that financial gravity eventually reasserts itself.
Okay, so we have the euphoric, AI-fueled market on one hand, and Burry screaming from the rooftops about an algorithmic apocalypse on the other. But while they're fighting that hyper-volatile battle, there is a third path being forged.
A very quiet path.
Yes, another legendary investor is quietly doing something entirely different with his billions. And we need to talk about Bill Ackman and the massive institutional overhaul happening at Pershing Square right now.
Bill Ackman has been undergoing a dramatic portfolio re-engineering over the last few quarters. And his moves tell a fascinating story about how mega funds adapt to changing macroeconomic regimes when they are caught flat-footed.
So Ackman just disclosed 6 massive new positions, and crucially, none of these are high-flying speculative AI startups.
Not a single one.
He bought Netflix, Visa, MasterCard, S&P Global, Alcon, which is a Swiss-American eye care company, and Intercontinental Exchange. Furthermore, he added to his position in Microsoft, but completely exited his stake in Alphabet, Google's parent company.
This shift raises an important question about strategy evolution. Historically, for the last 2 decades, Bill Ackman has been known as arguably the most noisy activist investor on Wall Street.
The classic corporate raider approach.
Right. His traditional playbook was to buy a huge, concentrated stake in an underperforming company, go on financial television, publish 100-page slide decks detailing their failures, and wage brutal public proxy wars to fire the CEO and force spin-offs.
He famously did it with Canadian Pacific Railway, Target, and Herbalife.
He did. But he is deliberately publicly retiring those noisy activist tactics. He has stated he is pivoting to a quieter, more cordial, long-term value investing approach. Look at the companies you just listed: Visa, MasterCard, S&P Global, Intercontinental Exchange.
These are not broken companies needing a turnaround.
Not at all.
They are essentially unregulated monopolies. They are toll booths on the global economy. Like, Visa and MasterCard take a fractional slice of almost every consumer transaction in the Western world. S&P Global takes a massive fee for rating corporate debt, which companies are legally required to have.
They are inevitable costs.
Yeah, these companies don't require massive capital expenditure to grow. They just print free cash flow.
Exactly. In modern portfolio theory, we talk about beta, which is a measure of a stock's volatility relative to the overall market. High beta stocks swing wildly, low beta stocks are steady.
Right.
Ackman is aggressively rotating out of higher beta, controversial plays, and into ultra-low beta, deeply entrenched, cash-generative businesses with massive economic moats. He wants businesses with a near-zero risk of permanent capital loss.
Well, we have to address the stakes here and why he is pivoting so hard right now, because Ackman is under immense pressure. Through July 2026, Pershing Square's year-to-date return was actually down 3.5%.
It is a glaring underperformance.
It really is. The S&P 500 is up 25%, breaking 7,800, and one of the most famous hedge fund managers in the world is down 3.5% for the year. He missed the massive AI hardware rally entirely.
And Ackman has built a multi-billion-dollar reputation on his historical 15.9% annualized return rate since 2004. Plus, he's currently trying to launch new retail-facing investment vehicles. To maintain that legacy and to attract new retail capital, he absolutely needs this quiet toll booth pivot to work.
So, what does this all mean? Let me ask you this, synthesizing what we've covered today. Is Ackman's move a subtle form of bearishness?
I think so, yes.
By buying these super safe, high-moat monopolies like Visa and MasterCard, is he quietly preparing for a severe economic downturn without actively shorting the market like Michael Burry? Is this essentially a defensive crouch?
That is a very astute way to analyze his positioning. Ackman doesn't have to short the market to express profound caution about current valuations.
He just buys safety.
Right. By hiding in these toll booth monopolies, he is essentially building a bunker. If the market continues its euphoric rally and a soft landing is achieved, Visa and MasterCard will continue to capture that robust economic spending.
Because people will keep swiping their cards.
Exactly. But if Burry's 1987 mechanical failure scenario actually plays out, or if the hidden leverage in the system snaps, companies with impenetrable balance sheets and guaranteed cash flows will survive the bloodbath far better than highly leveraged AI infrastructure plays. Ackman is buying downside protection through quality.
It's incredible. We set out on a mission today to unpack this profound financial paradox, and we've seen just how deep and complex the mechanics truly are.
It's a lot to process.
It is. We have the S&P 500 scaling 7,800, perfectly cooled inflation making the Fed's job easy, and explosive software earnings proving that AI can actually print money. But all of that is juxtaposed against a powder keg of geopolitical game theory in the Strait of Hormuz, phantom inflation in the data, and brilliant billionaires actively preparing for the market's algorithmic plumbing to mechanically fail.
It is an immense amount of conflicting data to digest, and for you, the listener, the true value here isn't in picking one side and blindly following the bulls or the bears.
No, not right.
True financial literacy is the ability to hold two completely opposing ideas in your head at the same time. The euphoric productivity miracle bull case and the apocalyptic accounting fraud bear case, and clearly see the structural validity and mechanical vulnerabilities in both.
Absolutely. It's about seeing the whole board, not just the pieces directly in front of you.
And as we wrap up, I want to leave you with a final thought to mull over. We've spent a lot of time today dissecting the plumbing of the market. Depreciation schedules, volatility targeting algorithms, off-balance sheet leases, and crack spreads.
Right.
The provocative question for you to explore on your own is this. In an era where passive index funds and algorithmic VAR models dictate the flow of trillions of dollars based purely on mathematical volatility metrics, do the fundamental earnings of a company even dictate its stock price anymore? Or are we all just surfing the wake of giant unthinking machines?
That is a brilliant and genuinely terrifying thought to end on, because if the diagnostic X-ray machine is broken and the machines are just trading with other machines based on synthetic leverage, well, what exactly are we investing in? Thank you so much for taking the plunge with us today. Keep questioning the narrative, keep looking under the hood of the data, and we'll see you next time on The Deep Dive.